In this video, I look at different channels through which the Canadian dollar can influence the profitability of food and beverage manufacturers and discuss what drives the value of the Canadian dollar. Currencies matter for profitability in multiple ways. First, many agricultural commodities that processors buy are priced in US dollars under the influence of North American supply and demand factors. Second, equipment in food processing plants is sometimes imported from the US, Europe, or elsewhere. And finally, food processors export around 35% of the value of their production. Of the total exports, more than 3/4 are shipped to the US, while the rest goes mostly to Europe and Asia. Let's discuss the first point related to commodity prices. It doesn't necessarily matter if manufacturers source the product they process from Canada or import it from the US. What matters is that the price of commodities is usually set according to supply and demand conditions in North America. As such, a stronger US dollar will mean a higher purchase price for processors when converted into Canadian dollars. Corn, wheat, hog, cattle prices are a good example of this phenomenon. The second point is that a higher value of the US dollar or euro against the Canadian dollar will also raise the cost of manufacturing equipment imported in Canada. So based on costs, a low Canadian dollar looks like a negative driver of profitability for food and beverage manufacturers. But we also need to consider the influence of our currency on revenues. In many cases, the products sold by food processors are also priced in US dollars. Hence, a low Canadian dollar against the US dollar can provide benefits as Canadian manufacturers obtain a higher price when converting US dollar denominated prices. A lower Canadian dollar also makes exports more competitive in international markets, supporting Canadian product sales. Note that a strong US dollar is also associated with a lower demand for agricultural commodities. This is because multiple buyers worldwide see their purchasing power usually decline with a strong US currency. If their purchasing power declines, commodity demand will be weaker and thus prices will trend lower. So there are multiple influences on revenues and costs. Generally speaking, a low Canadian dollar has a positive influence on the profits of food and beverage manufacturers. Of course, there are exceptions, especially when sales are made in the Canadian market, while primary inputs, material, and equipment are imported. Given the importance of currency values, how do we track and explain exchange rates? Just like any other commodity, supply and demand determine the value of the Canadian dollar against a foreign currency. The demand Canadians have for other countries' products, that is what we import, and the demand other countries have for our products, that is what we export, will determine the relative value of two currencies, and that's what we call the exchange rate. For example, Canada exports millions of barrels of oil daily to the US. Oil is a commodity priced in US dollars. The higher the oil demand is, and its price, the higher the demand for Canadian dollars, because Canadian exporters must convert the sales proceeds into Canadian dollars. Historically, the Canadian dollar and oil prices tend to move in the same direction against the US dollar. But the exchange rate is not all about oil. To see why, let's look at the 2021 to mid-2023 period. The chart shows that the Canadian dollar overall lost value against the US dollar. Its value started sliding in the early summer of 2021 to the fall of 2022. From that point on, it remained in the range between 72.5 cents and slightly over 75 cents. Let's look at if the movement in the value of the Canadian dollar coincides with the movement in oil prices. There isn't a clear connection between the two lines. Oil prices moved upward from January 21 to June 22, but that did not prevent the Canadian dollar from losing value against the US dollar. This means there must be other factors driving the value of the Canadian dollar. The exchange rate is also a function of interest rates and the relative strength of the economic outlook for the two countries. When interest rates in one country rise or are expected to increase faster than in another, investors will move capital to where they will get the highest return. That means there will be more demand for the currency where interest rates will be higher, which will drive up the currency's value. There's also a third factor to consider, the US dollar's value as a safe haven asset. When there's turmoil in financial markets, investors value the stability and strength of the US dollar. Despite multilateral talks and efforts to lower the dominance of the US currency in international trade, the US dollar remains dominant. At the end of 2022, it still represented almost 60% of all foreign exchange reserves worldwide. That's a drop from 70% at the end of the 1990s, but it's still much higher than the distant second currency, which is the euro, at 20%. And the Chinese yuan only represents less than 3% of all foreign exchange reserves. So it's really supply and demand that determines the value of a currency. Overall, a lower Canadian dollar remains a positive driver of profits. Businesses can leverage the relationship between the exchange rate and their bottom line to construct relevant currency risk strategies. Looking for more economic insights and expertise? Find tools and resources to help you manage your food and beverage business at FCC Knowledge.